Hello and welcome to The Trade. Let's get you caught up on what traders are watching. President Trump's tariffs spooking investors, fears of an economic downturn driving a stock market sell-off that's wiped out about $4 trillion from the S&P 500's peak from last month when Wall Street was cheering much of Trump's agenda. A key economic advisor to the president has pushed back on talk of recession stemming from uncertainty around the administration's tariff policies, even as a survey of American households showed consumers growing more pessimistic about their prospects. US Treasury Secretary Scott Bessent spoke to Saudi Arabia's finance minister about efforts by the US to stop Iran from acquiring a nuclear weapon. Copper prices have slipped as the market focuses on the negative consequences for global economic growth, while gold prices also fell, with profit-taking countering support from safe haven demand, which has been fueled by geopolitical uncertainty. Let's get more into gold and the technicals now with Peter Pan from ACY Securities, who joins me now. Good to see you, Peter. So, as we do see this fear for recession, we mentioned the gold price overnight took a hit, but is it going to be more supportive broadly for the safe haven? All right, I don't think we can hear Peter, unfortunately.
Hello?
Oh, yes. So, Peter, if you can just start with your thought there in terms of what you think the support could be for gold.
Okay, so to answer this question, we first need to determine whether the US is actually in a recession. The recent pandemic over recession started last week, mainly driven by the stock market itself, of course. But a key factor was that the Federal Reserve of Atlanta has dramatically reversed its US GDP growth focus from 2.3% to negative 2.8% in just 2 days. So this triggered a wave of pandemic selling in the stocks market and a rush into the US Treasury. So we need to dig into the Atlantic Fed data. Their report has showed that the major turning point was the GDP report released on February the 28th, which flipped their focus from positive growth to negative growth. What's the biggest drag? It is the net exports, which shaved the 3.7 of GDP. But it is not due to the falling exports from US. It is massive surge in the imports of US, specifically a 20 billion spike in January, and nearly all of those are gold. So let's see another chart. So the gold import during the January has risen from like 10 billion to 30 billion, which makes up the most part of it. So the reason behind that is the market's fear about the Trump's tariff would dispute gold trade, leading to an early physical transfer to gold, a move I called tariff-driven gold transfers. That was not only just about gold. Similar movement has happened in nearly all industry material, like the copper, like aluminum. The only thing doesn't be influenced is iron ore. So that's why this commodity price rally from last December until mid-February, which is exactly the same as the gold price rising until when Trump delayed the tariff. So the gold price doesn't surge due to the recession fear. Instead, the global shifting of gold into US has triggered the GDP data goes down and triggered the fear of the recession. So the gold trade is the reason, not the result. So let's take a fresh look about gold. Over the past 3 months, its correlation with the US bond yield has been close to zero. So it's nothing about the fear of the market, the rush into the safe haven. No, nothing about that. The main reason behind that is just because of the commodity price rising, the oil market. So this suggests that the gold price won't going further up. Due to the recession there, it will keep going down. and now it has already break through 2,900. The first target I will see is 2,850, and then it will be 2,800. Especially recently, there is some key environment change we can see in the market, like the New York gold stock cost, the New York gold inventory growth is slowed down. The gold lease rate returned to the normal from 6% to 0%, and also the New York and the London gold price spread has dropped down from the top of $16 in January to now only $10. So all combined, I will short the gold. Yeah.
Peter, just quickly, talk us through what you're seeing with the stock market trending down and whether or not that's going to continue.
Okay. So recently, the US stock market trending down is mainly due to the fear of the recession. However, let's see about the heat map in this stock market. The performance of different sector is completely different. Like the big seven, despite the Apple, the big six is doing the worst. However, other stock sectors is performing not bad, like the STEM consumer, like utilities and also healthcare. These are performing all good. It is not a traditional like recession trend. It is just about the market value change. So this always happen during the financial reporting season. If we see the next chart, so from the last four recession, the reporting season, the U.S. stock market always trigger a drop. Sometimes the drop is moderate. Sometimes the drop is huge. Like last year July, it's huge. But when we check those earnings season, the earning report is actually not bad. Let's say that this season, more than 60% of the company, even including the tech companies, has beaten the Wall Street expectation. So it suggests that it is not a recession, it's just a value change. So honestly, it happens time and time again. Whenever the U.S. market experience a sell-off, there always someone in the market, some analysts always say there is a recession there. So I don't believe it. I think the U.S. The GDP will still performing good. The recent GDP expectation going down is mainly due to the import. So if we come back to the Nasdaq chart, I will still see Nasdaq going down further in this week, but only this week because of the government short fear. But after that, I think it will come back to 20,000 or even break through it.
Okay, Peter, we're going to have to leave it there. Thank you so much. That does it for this edition of The Trade. Be sure to join us again next time.